contributing more than 2% to the GDP, or more than 7 lakh crore rupees industry, the defense industry. What we want to discuss today.
Good morning, everyone. The defense sector in India is currently undergoing a once in a generation transformation. For decades, it has been defined by imports and reliance on foreign technology. Make in India initiative isn't just a slogan, it's a structural change that is reshaping the entire industry. The landscape we see today is fascinating mix of two worlds. Let's have a look at the state-owned giants like Hindustan Aeronautics and Bharat Electronics, and a new wave of agile technology like data pattern and Zentech technology.
Now, we will have a deep research about the companies such as HAL, BEL, BDL, GRSA. If we are talking about the Hindustan Aeronautics Limited, they are dominant in aerospace as India's primary aircraft and helicopter manufacturer for the armed forces. HAL holds the largest share in the aerospace segment. Its revenue is a significant portion of the total defense production value in India. So basically, Hindustan Aeronautics Limited are the manufacturing of aircraft like Tejas, Su-30 MKI and products like these. Now, if we talk about Bharat Electronics Limited, BEL, leader in the defense electronics, BEL commands a substantial portion of the Indian defense electronics markets. It is constantly strong order book from the Ministry of Defense places. It is a leader integrator for many critical electronic systems. For example, it deals in the products like radars and weapon systems, weapons locating radars, surveillance, radars, naval systems, sonars, integrated combat, etc. Bharat Dynamics Limited, primary missile manufacturers. BDL holds a nearly monopolistic position in the manufacturing of indigenous guided missiles and underwater weapons, making it a critical entity with a high market share in the specific area. Missile systems like Akash, Astra, Nag, underwater weapons like decoys, and others. Garden Reach shipbuilders and engineers. Major players in shipbuildings, a key public sector shipyard that holds a significant share of the contracts for building warships for the Indian Navy and vessels for the Indian Coast Guard. Warships like frigates, P-17A project, anti-submarine warfare committees, etc. Data Patents Limited, emerging private sector forces, a rapidly growing private company in the defense electronics space. While its overall market share is smaller compared to the large PSUs, it holds a significant position as a key supplier to a critical electronic subsystem for major national defense. Warships like P-17A project, anti-submarine warfare. Zen Technologies Limited, Michelle leader in the training simulators, dominant in the Indian market for defense training simulations, deals in the products like combat training simulators, ATMG, small arms, etc. Astra Microwave Products Limited, key RF and microwave component supplier, a crucial private sector player that holds a significant market share as a supplier of high frequency radio frequency, deals in products like manufacturing critical RF and microwave components. Now,
What's your name?
the part one C. Yes, sir.
Now, before going on to all these basic ratios, let's understand one unique ratio which is very relevant to the defense sector, which is EV by order book. Because which is EV by order book. So this is a enterprise to order book ratio, which is very relevant in defense industry because it is a very high volume company and which have high order books and they have net cash more than the enterprise value.
Okay, just what's your name?
Nischay.
Mistake actually, EV upon order book, as you said, it's a very good metric which you are drilling. But because it takes longer time to when the order is received till the final product is given. So that's why this matrix is very important.
Yes.
Because it may take about months or years to manufacture a thing. So order books become very important rather than the top line.
Yes, order book only.
So that's why the order book
Yes.
is more relevant.
EV to order book. So the enterprise value captures all the value, equity, and debt minus the cash. And over here, because they're defense companies, they have more cash than debt. So the enterprise value is less than the equity value in most of the companies. And then the order book represents the future revenue pipeline.
So
And
just when you said that the enterprise value is less than the market cap,
yes.
Just when you show the.
Yes, I have a yes, I have
That's a good observation.
yes, because they are cash heavy companies. Next is the order book. This also represents the confirmed future pipeline of these companies. So here, because all the defense contracts and contract based government, so this is very relevant in this. Now, in this, why it matters? Because it's a forward looking nature. It does a comparative analysis and a good capital allocation. Now, he will tell you about the each ratio of each.
Now that we have understood that what EV ratios are, let's have a look at the company's uh, enterprise value, their order book, and their EV ratio, EV by order book ratios. So the Indian defense sector is split into two major categories: stable, value-driven PSUs and high-growth premium value private tech firms priced for their future dominance. If I talk about company-wise, let's have a look at Garden Reach. An EV book order ratio of 1.0x indicates a deep value, which means the company is valued exactly as its confirmed future revenue. As an analyst view, the safe defensive bet offering it offers high stability and its income is locked in for years. Making
The green, what was that company? You're
so,
talking
so the
about?
Garden Reach.
Garden.
Garden Reach shipment
So
builds.
what is manufacturing?
So warships.
Warships.
Yes. So if they so it's long locked in for years, making it an ideal conservative for investors. If I talk about Hindustan Aeronautic Limited, its ratio is 1.4x, which suggests a very reasonable valuation. The market price is slightly above its order book due to its MRO business, but its strength includes monopoly in military,
What is
aviation.
MRO business? Okay, go ahead, go ahead.
So machine repairs and operations. Machine repairs and operations.
Actually, this Hindustan Aeronautics is very heavily machine oriented. So that is why it is the machine oriented business because it has high raw value material. So its strength is that it is a monopoly military business and it has vast infrastructure. And as an analyst view, a core portfolio holding a safe defensive bet and its strategic importance to national security provides a competitive moat. If I talk about Bharat Dynamics Limited,
नहीं, बाहर dynamics. बाहर dynamics ही.
this is Bharat Dynamics. So at 2.3x EV to order book ratio, the valuation is beyond reasonable. It reflects confidence and its ability to secure a continuous stream of new missile orders. A balanced growth play, it combines stability of a PSU with growth potential of high-tech missile sector, which makes it very uh, eye-catching for investors. Bharat Electronics Limited, which is valued at 3.7x, which commands a premium PSU valuation. The market sees it as a technology company and not just a manufacturer, which its strengths are an immense diversification across all three armed sectors and its push into non-sectoral defenses sectors. As an analyst, a balanced growth play offers a safer way to invest in defense tech theme compared to richly valued private plays. If I talk about Astra Microwave Products Limited, it has an EV by order book ratio of almost 5.1x, which places it in the upper tier of valuations. The market is valuating it as a key technology provider with strong growth prospects. And as an analyst, it is very growth focused and its indigestion for defense electronics offers a very high potential PSU. Talking about Zentech Technologies, it stands at 18.3x, which is an extremely high premium valuation. The market is pricing massive future growth in anti-drone spaces. As an analyst view, it is one of the most highest risk, high reward opportunity as its investment is a bet that Zen will dominate emerging anti-drone market.
So, Shashank, I don't know whether you have answered for it or not. It's a high risk and high reward. So why it is a high risk?
So it is the highest company because the market that is valuating the companies is value to the company is very high. The P ratio, if we look at the defense company that we'll be talking about, I'll be explaining why it is overly expensive. I'll get on to that.
No, if the company is very risky,
Yes.
that means, which need to be further, analyzed. Why it's a
Sir,
risk.
so because it's risky because right now it is holding at a 18.3 EV. So because 18 times जो future में orders आएंगे, it is already valued today. So people are already betting. So you need not small growth, you need massive growth. तो अगर massive growth आती है, तो this will give you returns. But अगर वो decent growth ही करता है, so it is already being valued for that growth in today's time. And it is very high risk.
And also it is one of the
Normally, it's the converts a high P ratio or high EV to order ratio means it's value at a premium.
very free. Yes.
So that means, when a company is very risky, it will be valued at a lower multiple rather than the high.
So actually,
जो company risky होती है,
that is
उसका multiple गिर जाता है. People are not going to buy it. So the company which is riskless will have command higher, multiples. Right. So in this case, this company is at commanding 19.7, which one? This one.
sir, it is at 18.3.
ये क्योंकि it's a special case क्योंकि एंटी डोम people नहीं मार्केट टैप कर रहे हैं ना, तो इसीलिए मतलब नॉर्मल उसके लिए नहीं है.
Sir, also it is one of the few companies which is classified in the indigenously designed, developed, manufactured defense player,
Fine.
which gives them a very high push over defense procurement.
Take it point. Go ahead.
And last but not least, if I talk about data pattern, it stands at a 19.x EV orders, which commands the highest multiple in this sector. The market is valuing it as a high growth tech stock with exponential potential. And why is it? It's because its strength is in unique, vertically integrated business model. And it is a prime example of new age private defense tech company, which is focused, which is one of the very few companies that are focused on high margin and complex electronics. And as an analyst, it does come with a high risk and reward ratio, but its rich valuation is backed by strong and unique business model.
Now let's go to the basic ratios.
Okay. Just show the market cap first. We'll just. So,
Here comes the market cap for
market cap
So,
is
see,
like-
Now when you see over here, this is our market cap, which is 2,99,000 crores. Now when we come over here, we see how it is a very cash heavy company. 38,000 crore, it has a net cash equivalents. And this lies for almost all companies in defense sector.
Show the other ones.
So,
Keep on.
you see, now this is 9,500. This is 4. So if you see the percentage, is 10% of the market cap, it holds that much cash in it. Again, more than 10%. So this is low. These are small companies. But mostly these companies, when you see the market cap, it is higher than the EV value because they're very cash heavy. And when you see the debt component, it is almost zero.
Any reason why they're holding so much of cash?
So because if they have a unstable cash flow. If order comes today, they do not. If because of so,
So
and
they will receive
Yes.
amount through the order.
Yes.
So that will be lying with them for
Lying with
time.
and because if for example government gives an order today, they need heavy funds to actually complete that order. So they need to be having cash reserves, a lot of cash reserves, and their asset.
Point taken. Although that means they're maintaining heavy
Yes.
cash because they get orders,
Yes.
they
And-
get cash 100% advance, and then they build the order.
And it is low debt because it is one of its kind. Every company makes its own unique products, and they are facilitated by government also. So that component is very less. Moving forward, we go towards first the
Show
state.
me the top line sales is 31,000.
Yes. EBITDA is this a very high EBITDA companies because everything is because they are mostly a monopoly. If this creates Bharat Electronics create warships, they create the parts, they create something else. And hence only we were comparing big companies to small because there are limited companies in the sector and everybody is unique to some other product. So they all come together to form make
all
a
sectors are
Warm
integrated.
ship.
One is making the
So now-
raw material, other is making the electronics for that company.
Now coming to price to book, price to sales, EV by sales, we have discussed. So it is on a premium side only, where we see the price to sales is approximately an average of 12.5 and P ratio is approximately an average of 59, which is valued very high because right now government is making many schemes towards the defense sector. A lot of budget is aligned towards the defense sector. Everybody has high hopes from the defense sector due to incoming World War III, World War II. All companies are investing in defense sector. So everybody is taking a bet on defense sector that we will make our own jets, own missiles, everything. Hence, very rich valuations. is already being offered to all the companies where we can see our Dynamics has a
Which
99.2x.
company is manufacturer of jet? Hindustan Aeronautics.
Yes. So companies which are focusing. So now let me give you an example. Bharat Dynamics is recently started to make a missile. Hence 99.2x. This is like a lottery ticket. If it actually works and makes it, it will go to moon. Otherwise, it is a very high value because it will make a one of a kind missile in it, and it will be like the thing for India.
And the growth is how much? It is 33.
So growth is almost 33%. So all the small companies, because they're less expanded and they are focusing on the new technologies, the growth is very high, above 30%. The big players, Hindustan and Bharat Aeronautics, still a stable growth. They are stable companies because they have reached a certain level and they focus on jets. But these companies are focusing on new parts. Again, the PEG ratio, only Hindustan Electronic because of low growth is very high. Except of that, it is all in normal things. Now, to give you a recommendation on each of them. So, Hindustan Electronics. So, I will name it as a landlord of the Indian defense because, for example, the flights and helicopters are the tenants, and the MROs, the spare parts, are the guaranteed rent. So, the income is guaranteed very stable. EV by EBITDA is just 18.8x versus the median is 29. Hence, and a 1.8 lakh, 8.4 lakh crore order book. PEG is very high as compared to all, but still, because of stability, it is a good buy and a strong buy, which a person can do. Coming to Bharat Electronics, there's a subscription model. It has radars and electronics. Every year, the jet has to replace it. Every year, all the defense has to replace it. Order books are finalized. So hence the PE is very heavy, 50x, but it is justified because of the fixed order books, which is not common in this industry. And hooked by a 19% EPS CAGR, which is growing again and again, and 35% EBITDA margin, which is very high. So, and net strong cash, so quality compounder again, strong buy. Bharat Dynamics is a lottery ticket, as I told. It is lying and solely lying on its missile program. If it works, it will hit the jackpot. If it does not, it is being already valued at 99.2x PE ratio. Hence, PEG is still PEG is still low, but the PE ratio is very high, and PAT is also so high beta. It is 2.75. Beta is 2.75, which is the highest volatility according to the market also. So it is a very risky thing. I would say reduce or sell into strength when you actually see lower valuations in the PE. Then comes to GRSE. It is a volatile one. It is a project contractor. It has lumpy orders like real estate projects, chunky cash flows when milestones hit. PEG is again 1.43, which is the best in the group, the lowest PEG. And you can actually strong buy and accumulate it slowly. Now coming to Data Pattern, which is a smaller company. It is a startup kind of a company, niche IP. It has high margins, but it's a small scale as compared to these all companies. So hence we can go ahead and see if there's a dip and buy upon it. EBITDA margin is a whopping 50% because it mostly is in technology of this all these softwares, and P P is about 20x. So strong business model, but you can buy when it is on a dip. Coming to Zen Technologies, it is a video game company. It does all the simulators, anti-drone, high margin, scalability. It also has a high EBITDA margin of 51% and PAT of 33% after tax. PEG is also 1.5. So it is like a 1.48. It is again a good company. You can buy it for long term because it's small. It has a lot of growth opportunity. Astra Microwave, on the other hand, is an export gateway. All these companies are still limited to India. This company has high potential for exporting internationally because it has radar and EV subsystems which have the same standard across all defense programs across all the countries. So it can also export its programs. Hence, EV upon EBITDA, which is 21, which is the cheapest upon all these. P is 61, which is high heavy. But because of export opportunities, we can see solid value of growth, so we can buy and accumulate as a cheap valuation. Hence, these are the recommendations, and we can see how we calculated the growth and EPS of these companies, every company, and then put it into this value.
We also saw that the new GST reforms did not have any large impact over these years
Because
over the years the raw materials will get cheaper. So hopefully we'll see a better surge in the increase.
right of GST.
Just show me the recommendations there. So, the overall, your listing.
Yes.
Excellent job. I think you have done a lot of hard work along with John that journey. So, you have done a great job. And the recommendations, like buy on day or, long term, buy and accumulate. So these are, generally people use only the stock market.
Yes.
But this is a wonderful, kind of outside what you have given. So overall, it's wonderful. So carry on, please. Okay.
Let's now discuss the cost of these companies. Coming to costs. Cost पीछे
This is cost.
yes.
Break even at low.
So let's have a look at the cost and how much the company is dividing its funds into each of the materials at the cost that I have listed. So let's have a look at the primary cost drivers. So across India's different companies, cost structures fell into two broad buckets. One is the platform builders. For example, HAL, GRSE, and Bharat Dynamics. Here, the raw material accounts for almost 45 to 55% of the total costs, which covers steel, alloys, composites, many more. For instance, Hindustan Aeronautics aircraft programs are heavy, material heavy, while GRSE's warship involves massive steel production. And the other one is the electronics subsystems, which comes under data patterns and Astra Microwave. So Bell, Data Patterns, Zentech, in these firms, labor and R&D forms almost 25 to 35% of the costs. Since skilled engineers, software designers, and systems integration is
These are basically software-based companies, and those are hardware-based.
exactly. So that is why they have heavy raw materials and
Less
they-
of raw.
and less of labor wages. They are compared to data patterns and Astra Microwave, as they have to offer more money to their skilled laborers to retain them. And if I talk about sector linkages on why costs are high, then it is because the electronic simulators have high R&D that I've already mentioned. And if I talk about some validation, the Ministry of Defense has a positive indigestion, which shows exactly why PSU builders have high material costs and are targeted for localization, while private players are incentivized to absorb more R&D and cost in returns for IP ownership that we've already discussed on why Astra Microwave will have a more better growth. And if I summarize it in dependency and risks, then the import dependence in India has cut imports from 11% from 2010 to 4% in 2025, which is a critical gap which remains in aero engineers. So this is why proving more R&D intensive, these companies will have a better growth in future. And if we talk about the growth outlook,
Ashit,
Yes. So talking about the growth outlook, we can clearly see that the growth is structurally engineered by government policies that is made in India. The goal is not just expansion, but it is about strategic independence. Now, the primary challenge that they are facing is mind the gap, overcoming a persistent technology gap with global leaders and reducing dependence on critical important subcomponents that are semiconductors. Moreover, talking about import substitution, a massive immediate opportunity exists to capture a greater share of India's own defense budget, one of the largest in the world. See, this we are talking about national, and this is the international. If you compare and go, in talking about the primary challenge, it's in international thing, it's managing complexity, navigating incredible complex multinational supply chains, strict export control regimes, and the spiraling cost of next generation's R&D. Talking about the primary challenge that is there, that is there in international, that is navigating incredibly complex multinational supply chains, strict export control. Then the key opportunities that are there is import substitution, a massive immediate opportunity exists to capture a greater share of India's own defense budget, one of the largest in the world. Whereas in the international thing, technological integration, the biggest opportunity lies in integrating emerging tech like AI, quantum computing, and autonomous system into a single system. Talking about the future outlook that is there, the trajectory is towards becoming a major global hub for cost-effective, reliable defense electronics. Success depends entirely on consistent policies and successful gaps. Whereas if you talk about international thing, the trajectory is towards fully autonomous AI-driven and network integrated warfare. The future belongs to whosoever can master the data and the decision on the multi-domain of battlefield. Talking about the growth snapshot that is CAGR trends, HAL has 10.3% CAGR, which implies that steady policy-driven growth with large, long-cycle aircraft programs. Lower CAGR reflects HAL's maturity as the PSU giant with stable but slower expansion. Talking about the BEL, 19.1 CAGR that implies strong R&D led momentum in radars, electronics, and EW systems, whereas balanced growth from domestic orders plus exports that are there. In the case of BDL, that is 33.6% CAGR, rapid scale up driven by missile orders, that is Akash or ABGMS. CAGR reflects order book convergence and strong demand visibility that is there. In GRSE, it is 36.5% CAGR. That is shipbuilding modularization, delivering accelerated revenue recognition. Naval programs provide multi-year tailwinds. And data patterns, if we see, that is 28.6 CAGR, growth led by high value avionics and electronic content, strong development to production pipeline boosting scale. In Zen Technologies, it's 31.1 CAGR, near monopoly in simulators, that is 95% plus market share in the tanks. Aggressive export orders and entry drone system fuel expansion. At last, it's Astra Microwave with 25.9% CAGR, steady growth in RF microwave subsystems across defense and space. CAGR highlights niche strength despite being a mid-cap specialist.
So this, Arshit, sorry, yeah, Arshit.
Yes, yes.
So this growth represents the growth in top line or bottom line?
So in the top line.
Huh?
In the top line.
Top line. So, ठीक है, ये slide आपने बनाया.
Yes, sir.
Very good job done. Just go at the top. Market side. ठीक है, fine. So good. So, Arshit, you have done a very good job. Right? Doing
Sir,
that.
there is more.
Some more.
Now look at the strategies how these companies can grow.
Okay. So,
Now the meeting.
part after red parts कर रहे हैं. अच्छा. दोनों.
Sir, not talking about the mitigating strategy that is there.
So normally I'm not stopping, I'm just listening to all of your presentation because it carries 25 marks. Okay, so even if you take longer time, no problem.
Done. Thank you. Now, company by company refined strategy snapshots that are there. In the case of Hindustan Aeronautics Limited, that is HAL, it's scale plus program locking. What they do, prime indicator for aircraft, helicopters, engine. The strategy that they are using is lock large multi-year government orders. Example, 62,000 crores for 97 LCA MK1A to secure capacity utilization and cash flow, vendorize manufacturing to provide MSMEs to shorten lead times and de-risk single sourcing, expanding product mix. That is trainer, rotary, and AMCA participation. Now, resulting advantage that we have got is high revenue visibility and bargaining power with suppliers, but execution risk on the engine and the suppliers readiness. Now, the analyst recommendation that is there is focus on suppliers performance KPIs, stage payments, LD clause in contracts, and priority in strategic capex for engine and avionics.
Bharat Electronics Limited. What do they do? Radars, EW, communications across platform. Strategy: maintaining high R&D intensity, that is 6 to 7% of revenue, and platforms level integration. Diversify into integrate subsystems, capture long-term platforms content on Navy, IAF, Army programs. Resulting advantage: sticky government relationships, high value add, technologies lock-in. Analyst recommendation: continue export push for indigenized radars and scale midlife upgrades for recurring revenue.
Now, talking about the Bharat Dynamics Limited BDL, missile system scale and indigenize. What they do? Missiles in subsystems, that is Akash, EDGMs, and torpedoes. The strategy that they are using is protect and expand missile franchise while continuous trials and indigenization that is reduce import content and institutional overweights. Order book somewhat around 22.7K crore. Resulting advantage that is there, higher entry barriers, qualification cycles, and predictable demand for defense R&D time. Talking about the analyst recommendation that is there, secure supply of critical components, lock multi-layer supplier contracts, and expand export compatible variants.
GRSE, what they do, monopoly in naval warships, strategy, adopt modular construction to shorten shipbuilding, cycle times, and parallelize projects. Result advantage, improved schedule performance and reduced LD exposure. Analyst recommendation, strengthen systems integration and supplier base for high-end modules like combat systems and engines.
Talking about the data patterns, that is depth to broad electronics flywheel. What they do, avionics, radar modules, space and defense electronics that is there. Strategy that they're using is invest in house development that can be qualified into repeat production. Target platform is OEMs and exportable subsystem that maintains strong gross margins by converting prototypes into serial production. The analyst recommendation that is there is institutionalize IP protection, pursue strategic joint ventures for scaling PCB assembly capacity.
Just cover the key risk the Indian defense has.
So till now we have studied all the good part. Now coming to the risk that these companies face. Supply chain volatility. Risking cost and disruptions in specially metals, imported subsystems expose manufacturers to margin pressure to delivery delays. Execution and schedule risk. Defense contracts carry strict timelines and slipping in project milestones, example aircraft engines, ship modules can trigger penalties and erode credibility.
Just hold on, I'll say. Supply chain volatility, execution and schedule risk.
Well, customer dependency, like mostly are dependent on government, technologies and talent constraints. Like what is the technology going on in other countries and as well as our country, geopolitical and policy uncertainty. So again, who is the ruling party and what contracts they are doing for these companies? Capital intensity and cash flow stress. So mostly the major companies need a good amount of cash and yes.
Okay, that's over. So,
Like I would suggest
let us conclude.
So, sir, basically, when we like these are the company-wise data which we have put over here. This is the price target, etc. Like when we can see analyst rating strong buy. This for HAL, this for BL. But like in Bharat Dynamics, again they have given a analyst has given to strong buy. But we would consider yes, we can see it's a buy. But according to my research, I would say it is a sell and it's not a buy, and I would like to decline because
Why you are saying that?
so I'm saying again because this was on the missile program. So we can see current TP is 15, but they have just estimated it to be 26.8. Again, when we see over here,
What are the charts telling?
so just a second. See, again, EPC is expected to. So everything is lying on one single contract, which is missile. And for example, it does not work out. And already we are paying a 99 PE ratio. That does not make sense. So
This is a trading at 99 fee.
yes, 99.2. So this I would like to decline. Again, this is for GRSC, the single chart, and this is for Zentech data. So basically, this is this. So on concluding, sir, this is a very big industry backed by government, and they have heavy cash flows and backed by government. Hence, small, say, biggest company have a very good EBITDA margin, work on very high EBITDA margin, high cash, but there is just a very fluctuation of orders and cash flow. Hence, they have to maintain the reserves, and all companies as of now are doing pretty well in the defense industry. Thank you.
Okay.
Thank you, sir.
Thank you. Sir.
Good, very good job done. And this was the most complicated, just getting my sector. And you have done a, lot of research, lot of hard work, it seems. And how do you find this project? Was it a lot of learning for you?